Okay, maybe it's gonna work. Okay, all right, I'm just checking if you're logged on. I'm checking to see, make sure we're here. And we'll get going in just a minute. And this is Lindsey with Regions.
Hi everybody.
And it doesn't look like we have anybody on yet, but I'll be posting this video on my page later, but hopefully some people will jump on for the live so we can get some questions, and I think we have enough to talk about, but if anybody has any questions, we can address those. So, okay, so Lindsey here, she's a mortgage expert. So what's your official title?
Mortgage loan originator.
Okay. So, there's different things that she wants to talk to you about, the different programs that they offer there at Regions, and I think the main thing I wanted to discuss is the hurricane disaster loan that's out there, the FHA 203H loan.
Correct.
And, there is a little bit of a time, restraint on that. We're coming up on a year since Hurricane Michael. It's hard to believe, but, there's a limited time that you can apply for that. So, I'm going to let Lindsey kind of take over, and I'll probably think of a few questions and we can address those. But I'm not sure exactly which ones you want to go over, because I know Regions has some special programs that only you offer.
We do. First and foremost, we do have the FHA 203H, which is the 100% financing for those that were qualified under having their primary residence destroyed in the hurricane. Yes. So this can be something that you were renting. It could be something that you owned, but it has to be declared uninhabitable.
So let me ask you about that. So, okay, so I've closed multiple of these disaster loans since the storm, and whether you rented or you were a homeowner, you both areas qualify. But to be deemed unlivable, what would they need? A FEMA letter?
It could be a FEMA letter.
Okay.
I had one where they had a letter from the fire department in Parker.
Okay.
Where the fire department went in and took some photos and deemed that it was uninhabitable. So it could be any kind of government agency. It could be your insurance. So if your insurance gives you a letter that states that the home was a total loss, that 100% qualifies. What will not qualify is somebody that was living with a family member and that house was destroyed. Unfortunately, if we can't tie you to that property as far as a lease or a deed, then we cannot use that as qualification. What also will not qualify is, say you're renting somewhere and you had to move out for a little while, but you were able to move back in because the homeowner made the repairs. At that point in time, where you live at is livable, and that's where you lived during the disaster, so we would not be able to use that as qualification.
Okay, so let me ask you this. I did have a case like this come up that there was a renter, and it was deemed unlivable, and the property was still sitting, without repairs or anything. But I know they were requesting the homeowners to give them something from their insurance company. And, of course, legally they don't have to do that because it's personal information.
That's correct.
But is there something that you can go in there and take pictures of the home to deem it unlivable? Or?
Yes.
Okay.
So if the house is still sitting where it was from the time of the storm and it's still uninhabitable, there has to be conclusive photographic evidence to show. So with that being said, there also has to be proof to tie you to that residence. So you have to have a lease agreement that shows that you were there during the storm, or a voter's registration card and or driver's license that shows that address.
Or about utilities in your name.
That can also work.
Okay. Okay.
Yeah, if you can show utility bills that were from that time frame that had them in your name. Again, it can't be a situation where somebody's living with a family member and they have the utility bill in their name. I mean, obviously, it would have to be a lease agreement, or they want the more documentation, the better.
Of course, yeah. Okay, so it's a 0% down, but you still have closing costs. and that's that kind of jumps over to my lane. So the 100% financing loans, that's what they are. They're 100% financing. You don't have to pay a down payment, but there are closing costs that come into play. Now, if you offer, okay, sorry, my phone was screaming at me. So you can work with the seller and ask for them to help you with your closing cost. So essentially, the 100% financing loan, and then get the seller to help some with your closing cost if at all possible. That's one thing we can do, or try to do. So, and I just want to say, hey guys that have joined us, thank you for watching. Please share it and share the information. But, okay, so what else do you want to talk about? What other programs? Which one do you want to go to now?
Well, we want to stick with low and no down payment right now because I feel like that's primarily the market that we're in. So another benefit of, I will say, to add on to what you said about the FHA, is that they will exclude the if you have a current mortgage debt.
Okay, that's a good point. Okay.
So some of you may be out there and you say, well, there's no way I can qualify because I have this mortgage debt, and it's in a house that you can't live in anymore, and FHA will look to exclude that debt, assuming that all other qualifications are met for that loan program.
That's awesome. Okay, so and I do have one customer, or she's a friend and a customer in mind right now. She had to bulldoze her home, and her and her family are living in a camper, and so she's stuck between rebuilding or buying something else, and then possibly rebuild and rent that later, but it's good to know that even if you still have a mortgage, and you can move forward with this too. Now, I also had someone that had a VA loan on their current property, and it was deemed unlivable, and they would have actually qualified for the FHA as well. So, I mean, you have options. So it's good to call and check, and you can call me anytime. I can send you to Lindsey, or and then vice versa. So, but is there any other stipulations on that one that I'm forgetting, or benefits besides?
No, I will talk about a success story with that loan program for those of you who may think that there's no hope out there, because I think that all of us feel that way sometimes, especially when one thing after another after this storm. But I had a couple that came in, and they wanted to buy a home. They were renting at the time of the storm, and they had been living in a 500 square foot room with 3 big dogs from October 11th until they came to see me in April. Wow. And so luckily they had a place to live, but some people don't. Right,
yeah, that's very true.
And so, you get kind of desperate. You start thinking, well, what can I do? What can't I do? And I'm here to tell you right now that they ended up qualifying for the 100%. Awesome. They came to the closing table with $395.
That is fantastic. And I've closed, like I said, I've closed multiple. And same scenario where I said before, we can work with the sellers and hopefully, have them cover a portion of the closing cost. And so essentially you can get into a home for little to nothing. And, having a mortgage paying your mortgage is better than paying someone else's mortgage, if you can do it.
Absolutely.
So it's an investment in yourself. So, and I totally understand there are some people out there that just are not in the place right now to be a homeowner. But, to be able to invest in yourself instead of your landlord, and then also have the benefits for your family, if you can do it, it's totally worth it.
Absolutely. So. And FHA, the 100%, you do not have to be a first-time homeowner.
Right, and a lot of people have that misconception that it's a first-time home buyer, that you use it one time, but that's not the fax. The fax is what, once every 3 years, as long as it's your primary residence?
That's absolutely right. And then the credit score minimum is 580. So those of you who may have had some credit problems after the storm, say that you missed a payment and now your credit score is dipped. FHA is pretty forgiving in that department. 580 is the minimum. And then, say you don't have a 580, we can work with you.
Right, and that's a good thing. I talk to many people, and they say, oh, my credit's not good, and a lot of times I'll have people tell me, oh, my credit score's a 650, and I'm like, oh, you have options. And not only that, if it is a 570 or 560, if you get in touch with Lindsey, she can educate you on how to proceed to raise that number. And a lot of people have the misconception that, say I have a car payment and I have credit card payments. Say, oh, I want to make an extra car payment. When in reality, making extra payments on the credit card would be better than that. So she can steer you in that direction and guide you on how to raise that score.
Absolutely. Because the way the mortgage industry looks at debt is completely different than anywhere else. And, the best thing that I can do is when somebody comes in and they're not quite there, let me talk to you. Let me look at your credit report. Let me uncover what we need to do and what your means are in order to put you on the path of success for owning a home.
Right.
That's the most important thing. I've worked with a girl that she came to me and her credit score was 543. And this was right after the disaster. She's a single mom. And I ended up working with her. I gave her some options that we have. We have some credit building options at Regions. And she did exactly what I asked her to do, which was the key to that. You do exactly what I tell you to do.
Yes.
Exactly.
Yes.
And she did that. And within 6 months, her credit score was a 653.
That's fantastic. And, people that, I've been there. Your credit score drops and you feel helpless and you feel, oh, well, there's nothing I can do. It's pointless, but you have options. Hey, Katrina.
Hey.
How long do you have to pay a PMI with a FHA before refinancing to a more conventional loan?
On FHA, that is one loan product where mortgage insurance is paid for the life of the loan. Don't let that deter you, because if it's the only option that you have and that's, what your credit score qualifies you for, then I say go forward with it, because FHA, I believe what Katrina is asking is that when are you eligible to refinance?
Right.
So on a conventional loan product, you will have private mortgage insurance from 5 to 7 years if you put the minimum down payment. And that will fall off whenever you are at 79% loan to value. You can get an FHA loan, and once you have some equity in your home, so again, 5 to 7 years, you'll be at that loan to value where you can refinance into a conventional loan product, and then at that point, there won't be any PMI to worry about, because you'll be at the 80 or 79% mark, so to speak.
Okay, all right. So, also, speaking of refinancing, what's the rule of thumb to refinance if the rates have dropped? Is it beneficial to refinance at 0.25%, or should you wait to a full percent? Or
there's no hard and fast rule on that. What I like to do is I'll look at a few things. I will look at how long do you have left to pay on your mortgage. Okay. If you have 25 more years and we can get you a quarter lower, then why not? Let's do it. If you have 10 years left to pay, a quarter may not be beneficial after you look at closing costs. So.
Okay, Katrina, I bought a house. I am just hating paying the PMI.
So. Amen.
Yeah.
Well, Katrina, give me a call when you're ready. We can look at a conventional financing product to get you off of that FHA. Again, there will be closing costs incurred with that, but as you can finance your closing costs into the loan on a refinance. And a lot of people don't realize that. Typically, they want to keep it at 80% loan to value, so you can avoid the mortgage insurance. But, it just depends, because FHA does give really low rates because they have the mortgage insurance. So sometimes you can refinance from out of FHA into a conventional loan product and your payment will stay the same even if you don't have mortgage insurance, just because of the rate difference.
Right.
But it's always worth looking at, though. You just never know till you look at it.
Okay, all right. And like I said earlier, I'll have all of her information down in the comments after we're done, so you'll be able to get in touch with her for any questions. And of course, call me anytime. So, okay. So, what you want to touch on the regions?
Yeah.
100%?
I think this is a good segue, what Katrina mentioned, to bring us into that. So Regions does have several low, no down payment products that are exclusive to us. The first one being our Regions Affordable 100.
Yes.
It's 100% financing. There is an income limit on that, so you must be in a lower moderate income category. However, if the home that you're looking to purchase is on a piece of property located in a low to moderate income tract based on the Census Bureau, then there is no income limit on that.
Okay, so essentially what you're saying is there's a cap on the income.
Correct.
But if the home is located in the correct area, there's no cap.
That's right.
Okay. So
and that's why it's important to get with your realtor.
Right.
And your realtor will get with me and say, this is our address. Can you look it up? And I can look it up. I plug it in and I'll say, hey, yes, or hey, no. And so that's where it comes back to, we can look at, there's different credit overlays as well.
Okay.
But this product actually works really good for some people compared even to USDA. The ratios, the debt to income ratio for this product is more forgiving than USDA.
Okay.
So it just depends where you're purchasing.
So for those of you that don't know what USDA is, it's 100% financing loan as well, but it's in I say rural settings, but there's a fine line there because sometimes when you look at property, it's not definitely in a rural area, but it does qualify for USDA. It just depends on where the property is located, if it qualifies or not. So, and it is a government program, which I can tell you, when we had the government shutdown this past year, it does affect that loan. So, I had a deal going. We were supposed to close the following week, and we were stuck. We couldn't do anything. Mm-hmm. So, that typically does not happen, but it can.
It can.
So, but I wanted to ask you, the Regis 100%, is that a conventional? Is it FHA? Does it have a label?
It does not have it's considered conventional by, like on your real estate contract, you would put conventional.
Okay.
However, it is a portfolio product, and the advantage over other programs is that this does not carry mortgage insurance. Katrina.
Okay. See, Katrina caller. Okay. All right. That's good to know. So, okay, Katrina, there are income cutoffs for USDA. Yes.
Yes, there are income. That's the other thing. So, say that we're looking at and Katrina, she said there are income cutoffs for USDA, and that is correct. However, again, if the property is in a low to moderate income tract for our Affordable 100 product, there are no income limitations.
Okay.
I believe with USDA, the income caps off at like $92,000 for our area. And it may be less than that, but Regions Affordable, if it's in the right area, we don't have an income limit on that.
That's
so,
awesome.
Yeah.
Okay, and Sheila says, if you decide to sell a home and want to sit on the purchase of another home for a few months, what's the best way to store the money from the sale? So you want to sell your property, hang on to it until you find the one you want. What's the best way to savings, or where's the best place to put that money? Not your mattress.
Do not put it under your mattress.
Or in the freezer, or no. So
right. So I think what Sheila is asking is because everybody knows that when you're going forward with a mortgage, all money must be tracked. There must be a paper trail. So, so to speak, you can't go under your mattress and pull money out that you've been saving for 40 years and say, here's my down payment money, because the bank will ask questions. So the best way, if you sell a home, definitely keep your paperwork, your CD, your HUD, whatever you have, so you can track that this is what you were paid out, and deposit it into I would say an interest-bearing account. So you could put it in your checking account, but you could also open up a money market. You could open up a certificate of deposit, something that's going to make you a little interest, because it could be a month, it could be, 60 months before you decide to buy again. Okay. And you want to make sure that it's protected and that you are doing yourself a favor and earning some interest.
Okay. All right. Awesome. So this reminds me, I keep remembering things I wanted to talk to you about, but say someone comes into your office and they're self-employed.
Okay.
What's the guidelines for self-employment?
Well, there's no hard and fast guidelines for that. Self-employed, make sure that you claim your money.
Like tips and such. I mean, I know a lot of people work on tips, and it's cash tips. I get it for the, both sides, taxes and whatever. But if you don't claim that, you don't show that income for benefits of mortgage. So,
that's right. And so you can't, what April's saying is you cannot come into my office, so to speak, and say, well, I'm a server at ABC restaurant. My W-2 says I made $38,000 last year, but I really made $60,000. Well, where's it at?
Right.
Well, I'm telling you, I made it.
Yeah.
we have to have proof, and it's not just our institution. It is the underwriting guideline for anywhere you're going to go. It's set up by the federal government. They have a way that they want to see things. So self-employed, claim your money. Write-offs get people every time because of course none of us like to pay taxes. It's just a fact. But if you're looking at buying a home, you're going to want to limit your write-offs because you're going to want to show income, especially if you're carrying a lot of business debt. Mm-hmm. A lot of people, they buy vehicles, they buy equipment, and they put it on their own personal credit. And we can exclude some of that if we can show a 12-month history paid from a business account. So It has to be you have to be very clean about the way you run your business. If you have an Amazon card that you're paying every month, you cannot pay it from your personal account 1 month and then go to your mom's personal account and pay it, and then pay it from your business account for 4 months, and then it just doesn't work that way. So if we're going to exclude debt, it must be consistent.
I'm learning something, by the way. So
you learn something new every day. And also, we like to see a 5-year history of self-employment.
Okay. All right. So also back to the cash tips, money. So say you have the server from ABC Restaurant, and they have their cash tips. So they bring in, let's say, $300 a week in tips. If they deposit that money in their account, are they going to need something other than the cash deposit? Because you're going to want to see where that cash came from.
Right.
So how does that work?
Well, typically, if you're a server, and I've been one.
Me too.
You have a system that you can claim your tips. And so if you're looking to buy a home, I recommend for the next year, and say you're a year out, for the next year, claim every single bit of that cash that you're making, even if you have to pay taxes on it. Claim it.
Yeah. Okay. All right. Well, I learned something in that conversation. So, okay. Let's see. Let's touch on conventional. So there's a conventional of 5% down. Mm-hmm. And there's a 3.5% conventional.
3%.
3%. Mm-hmm. Okay. Let's talk about the differences in those.
Okay. Your 5% down conventional is going to be for those of you who are buying a primary residence, but maybe perhaps that you still own a house. And maybe you're going to make that house your second home and you're buying a primary because you're already a homeowner, so it won't qualify you for the 3% down. Okay. The 5% comes in because they expect somebody who's already a homeowner to be a little more well established. On the flip side of that, you have your 3%. And at Regions, we have a really great program. It is the Agency First Time Home Buyer. It is exclusive to us. And what it does is the bank will pay your closing costs. So you have a 3% down payment, and we will pay the closing costs.
Okay.
And something for you to know is that instead of the customary seller paid closing costs, so in a real estate transaction, we have the doc stamps on the mortgage that are paid for, on the deed that are paid for by the seller. And then we also have the lender's title policy that's usually paid by the seller. And in lieu of that, on this program, I'll talk to my agent and I'll say, hey, April, can you negotiate with the listing agent to see if the sellers would be willing to pay toward the buyer's escrows rather than because they don't have to pay their closing costs.
Okay, all right.
So again, another success story. I had a couple, first-time home buyer, and they came in with, I think they bought a $235,000 home. They came to the table with $4,000.
Wow.
So it even actually took some off of their down payment. Mm-hmm.
That is great. Mm-hmm. Okay. Let's see, learning more things. Here I am. Okay, Sheila says, if you sell your home, put a majority of the sale money aside, then decide to rent for 2 years before repurchasing a home, how does that reflect in getting a new loan? So she's going to take a hiatus.
Well, that's okay. Some people do that, and it could be for any reason. So, I've had people that say that you own a house and you had a hard time and you had a mortgage late payment. Well, all of a sudden you're not qualified to buy a new home because your credit score dropped. So there's nothing wrong with taking that and renting. Just you want to make sure if it's for a credit reason, pay your rent on time, pay it every month, and keep a record of it, because we can use things like that as non-traditional credit sources. Okay. Say you're going to rent for 2 years and you have the money from the sale of the home. A lot of people make the mistake and they spend all their money while they're renting. Yeah. So that's why I say it's very important to put it somewhere that you feel safe, that you'll make some interest. A certificate of deposit is a great place to put it. Just don't put it under your mattress.
Right. So I do know, let's say she wanted to take, so she sold her house and she wants to travel in RV, for a year. And how would that affect her? Will that have any means on?
No, the only thing that you want to think about when you go to apply for a mortgage is they're going to want to see job history. So if you're traveling in an RV for a year, you probably aren't working.
Well, retired.
Oh, retired. Well, then we'll look at Social Security.
Right.
We'll look at any retirement income, and then your permanent address. Of course, you're going to have somewhere where you get your mail. Right. So we cannot use a P.O. box for the loan purpose, but we can use, like, say you were claiming your mother's address. Mm-hmm. That can be your physical address, and then, you get a P.O.
box. Okay, sorry, my phone's dinging at me again.
Good question, Sheila.
Okay, so we were talking about conventional, correct?
Conventional. Mm-hmm.
And there was something I wanted to ask you about that. We'll have to come back to it. It'll come back to me, I think. Did you have something else?
I do want to add on to that. I want to educate those of you out there that are first-time home buyers, because a lot of people get kind of apprehensive when we talk about rate. We hear our parents talk to us about it. Rate. I mean, it's in the news. Right. The feds are moving the rate again. And if you're trying to get in a home and you're qualified and it's something to do with the rate, like for instance that first-time home buyer program, the rate is significantly higher. However, what that's doing for you is it's allowing you to get into a home and start building equity. Mm-hmm. And so if you have to pay that rate for 5 years, 7 years, most people, I think they say 75% of first-time home buyers either move, sell their home, they upgrade, whatever, after 5 to 7 years. Mm-hmm. So it's worth it taking a kind of a setback on the rate a little bit, if so to speak, to get into a home. Don't let the rate deter you from getting into a home.
Well, I can tell you, right now, here where we live, rent is very high. Mm-hmm. And I just closed a deal with a family that they were renting, and they purchased a home, and the rate was not exactly what they were expecting. It was only about a quarter percent off, but they're saving about $400 a month.
Really? Mm-hmm. From the rate being?
Well, from renting to buying.
Oh, from renting to buying. Mm-hmm. Okay, I see.
Yes.
Yeah, absolutely.
And that includes all the utilities, too. I mean...
And they probably got a lot more of a home than what they were renting.
Yes, a whole lot more. Plus, they get their tax write-off, and they are going to... It's an investment, so if they decide to move in a few years, they'll make money on their purchase. Yeah. So... for first-time home buyers, it's a scary process. And everybody that I work with that's a first-time home buyer, they constantly apologize for asking questions. But please ask questions, because you don't know unless you ask questions. And I expect them. And, you know, it's a scary thing. And to be nervous about it is normal. The people that aren't nervous, they scare me. I mean, it's a big purchase. Besides sending your kids to college, this will be the largest purchase you ever make. More than likely. And you want to be comfortable with it. So ask questions. So, Lindsey, ask her questions. Ask me questions. It's okay. So, with VA also, I wanted to touch on VA. Because with a VA loan, it's 100% financing. But you can use it multiple times. But tell us about that, about your benefits on it. How does that work for people that have never used their VA loan?
VA is wonderful. If you are struggling with coming up with a down payment, and we all know that, you know, the military isn't the highest paying job out there, so it's hard to save money like anywhere else. VA is amazing. You do not pay mortgage insurance with VA. Your closing costs are minimal.
Right.
And by law, institutions cannot charge more than a certain percent of closing costs. Like I think more than 1% of the loan amount they cannot charge on your fees. So typically, our VA buyer, they come to the table with, you know, the least amount of money down because there's no down payment required. The closing costs are minimal, and then the payment is also a lot lower because VA gives it gives a set rate. So I think right now VA is coming at 3.75.
Okay.
Now that's not to say if you're already a homeowner and you have money to put down, it's almost always better to put the money down and go conventional rather than VA, because the conventional rates change based upon down payment investment. But you know, for somebody who's wanting to use theirs for the first time or even the second time, say you don't have 20% to put down, then VA is an amazing, amazing loan program.
So let me ask you, so we have a VA member that comes in and they use their VA loan for the first time. So they go to use their VA loan a second time, and you say, okay, well, let me check your benefits. Can you explain that? Because some people don't realize that it depends on your amount of service.
That's correct.
So explain that a little bit so people understand.
So your VA, and you're using your entitlement for the first time. Maximum entitlement is $36,000. That's for everybody across the board if you've served the amount of service that you need to be eligible. Active duty is 3 years. Active duty, they want to see 3 years. Now it's a little bit different for reserves, National Guard, things like that. But typically, you know, your entitlement's $36,000. What that means is that there's a loan guarantee, so you don't have to bring any money to the table. That's up to a certain amount, and it goes from county to county. So if it's above, they want to see about 25% of the loan amount guaranteed. So they have a certain calculation that they use to do that. So that's not to say that you won't always come to the table with a down payment with VA. It just depends on how much of a house you're buying. You know, typically, even in the $300,000 range, you're still okay. It's just whenever you get up to like the 400s, 425s, then you start seeing some down payment. But, you know, you have your full entitlement. So the second go around, if you have sold the house that you bought the VA loan with, you have your full entitlement back.
Okay.
If not...
so let's say if you're renting it. If you decide to keep it and you're renting it out and you want to buy another house,
then your entitlement decreases.
Right, okay.
So, and I don't have that number off the top of my head. But
it's okay.
It does decrease, though. And so that's why it's very important to get with a lender who can take a look and say, okay, well, you know, your entitlement's not there, so you're going to have to bring this down payment. So is it worth bringing, you know, 10% down payment and paying a funding fee for a 3.75, or could we put this 15% down because you're not paying the funding fee on a conventional loan and get you at a 3.5? So those are the kind of things that we look at.
Okay.
Or another good one is if you're refinancing. And I had a man call me, and he has a VA loan, and he wanted to do a VA refinance. And he said, and I won't name the competitor, but this competitor was offering 3.25% interest rate. So I said, well, could you please show me, what you're working with here? And it was 3.25%. However, he had his VA funding fee, which is 1.25% because he was a refinance.
Okay.
So typically it's 2.25, but
right.
on this one it was 1.25. And then he also, they were making him pay a point. And basically, just for beginners, a point is you pay to get your rate lower.
Right.
You pay money up front to get your rate lower. So I look at it and I go to doing the math, and I was able to get him at 3.25, and he paid money up front, but it was less than what he would have paid with the VA funding fee and
nice.
The point that they were willing. So it just depends. That's why it's important to go
right.
to somebody, and you may think, oh, I need an FHA loan.
Right.
But not always the case. Everybody's different.
And that's what I tell people when they come to me first. Typically when a buyer comes to me, the first thing I'm going to do is send them to a lender. Because it's like going to shop for a car when you don't know how much money you have. You need to find out what you're approved for. Then we can start shopping. Because if we start shopping before we know, to put it point blank, it's a waste of time. It's a waste of your time. It's a waste of everyone's time. Because you may find a house that you fall in love with, but you won't be approved for it. You may be looking into homes that are less than what you're approved for. And you can go bigger or better, so it's always good to start with the lender. And you can start with me. We'll go over everything, and then I'll send you to Lindsey, and she can go over numbers with you. So, and small disclaimer: if you hear people screaming, they're having bunco here at my office. So.
They're having a good time.
Yeah,
somebody's winning.
We really don't have people locked up in here somewhere. So, anyways, you may not even hear them. I don't know, but. Kind of jealous I'm not, invited, but they have their 12 people, so
we're
whatever.
Having way more fun right here. So.
Right? So, okay. Let's see. What have we not touched on? Let me think. Can you, seeing Miss Christina here makes me think of it, but can you help people that want to buy a house out of state?
Yes.
Okay, so Lindsey here doesn't just work for Panama City. She's Regions is nationwide, so she can help you. So if you're thinking of moving out of state, another thing about the disaster loan is you can get approved for the disaster loan, but use it in another state. Correct?
No, opposite. So you can be moving from another state. Or no, excuse me. No, you're right. You're right. Okay, sorry, I got two things mixed up.
It's
Yes.
Okay.
So yes.
You're thinking about the grant program, aren't you?
I'm thinking about the bond.
Okay.
All right. So we'll talk about that in a minute.
Yes. Okay. Back up. Okay.
So yes, you can be approved for the disaster loan, and you can move to California because you're trying to get out of Dodge because there's nowhere to live or whatever. But you can do that.
Okay.
And then what I was talking about with something else is Florida is offering a $15,000 bond. It is for people who are buying in the disaster affected area. So it's opposite. So you could be in Washington State and moving here, and you could qualify for that bond. I'm not certified to offer that program. There are people in my office that are.
Right.
But from what I understand, the bond, it goes through 2 underwriting processes. And it's a good program, but it's not for everybody. So that's why it's important, again, to, get with April and then get with a lender. And then we'll sit down and figure out what's going to be your best interest, because you definitely don't want to go show somebody a house, and you don't want to go look at a house and think that this is your ticket to go get a house because there's $15,000 they're giving out to everybody, to find out that maybe your credit score wasn't there.
Right.
Or maybe your debt to income was too high for that particular program. So get with your lender.
Yes. And with the bond program, it's a large pot of money that the government has given us, and once that money's gone, it's gone. So I can't remember the total amount, the total figure that they gave us. I'll get it and I'll put it in the details. But
excuse me.
So each person that they're giving $15,000 to, once the pot of money's gone, it's gone. So there's not a deadline on it like there is with the disaster program, but it's just. My daughter's in the window reminding me of
the
things.
Deadline.
The deadline for the disaster program. So Good looking out, Kendall. Deadline for the disaster loan. We were talking about this.
Yes. We're switching gears back to the FHA 100% financing.
Yes. That affects the people that lost their home or their home is unlivable. There is a deadline to apply for that. So if you think that you qualify for that, call me, call Lindsey, let's get it going. So I would hate for somebody to miss out on that when it's such a good program.
Oh, absolutely.
And especially if you were a renter and your place was destroyed or unlivable, and this is your opportunity to get a 100% financing loan and not have to come out of pocket a lot of money and become a homeowner. So, it's a good program. So,
and the rates are very low for that program too. So you don't have to have much of a credit score. 580, your rate's low.
Right.
I mean, it does come with the mortgage insurance. However, in the bigger picture of things, you can get that refinanced.
Right.
Like Katrina asked, you can get that refinanced eventually. Get into a house.
Right. And another thing, a lot of people that don't realize is filing for homestead exemption. What that is when you buy a home, if you are a Florida resident, you change your tags, your license, you become a Florida resident. They give you a tax break on that because you're saying, hey, I'm going to live here. I'm going to put my money back into this area. My tax money is going to go here. So they'll give you a tax break on it, and it will essentially lower your payments if you file for that. So I feel like we're forgetting something. Are we forgetting one?
We've talked about FHA. We've talked about, we haven't really touched on FHA, the normal, regular program.
True. It's a 3.5%.
3.5% down payment, 580 credit score. Again, it's one of those that it helps a lot of people because you do not have to be a first-time home buyer.
Right.
That's where we start looking at FHA, is when the credit score is lower, or say that you already own a home and you really don't have a lot to put down. FHA really comes in clutch for that because you only have to put 3.5% down. The rate is low, and FHA is more forgiving on the debt to income ratio too. So, we all know the market, we know the area here, and there's kind of a big disconnect sometimes between the wage and then the housing market. And so right now people are shopping at the top of their price range because that's what we're in right now. The market is high. And so say you find the perfect house that you love, and you're sitting at a 48% debt to income ratio. If your credit score is under 700, conventional loan, you can't do it. Right. Because they cap off at 45%. So FHA has some really good qualities, and I don't expect anybody to remember all of this stuff, but that's my job, and that's why it's very important that you call somebody. And
I don't remember it all. I mean, sometimes I have to call her and say, hey, so what did we talk about this conventional loan? So, that is her lane, and finding you the perfect house is my lane.
Yes. So if I pre-qualify somebody, and I'll call her, and they'll call me first. They skip April altogether, and they call me and they say, hey, they give me their information. And at that point, I'll pass along to April here and say, I've got this buyer. They're in the $120,000 price range. They could tell you a little bit more about what they're looking for and what area, but I can tell you right now that this is the low to moderate income area if you want to do the 100%. And then it's very important that your realtor and your lender have a good relationship.
Yes, definitely. So, and then the USDA, let's touch on that because we kind of talked about it, but what are the qualifications for the USDA? We know it has to be where the property is located.
Correct.
Okay. So, but on your end, what's the qualifications?
Credit score, they want to see a 620.
Okay.
So 620 credit score. The debt to income ratio is not as forgiving. So this loan, it has a higher income limit. Again, I think it's around 96,000, something like that. And that's household income. So say that April and I are married, and we have a nephew that lives with us, and he makes money too. They consider every adult in the household their income. Okay. So that's kind of one of those things that can disqualify you. Like if me and you are making our income and our nephew, he's making his, and all of a sudden we're over the the cap.
Right.
So if they do go on household
income. So if
income,
you have a parent that lives with you, or a, yeah, okay.
Right.
All right. That makes sense.
So the USDA is a great program because it does offer 100% financing, and you can even go over the limit to finance some of your closing costs into the loan.
Okay.
There are caveats. So, people come in, they think USDA, that's what I want to do, but then come to find out that maybe their income doesn't qualify because they didn't realize that it's household income, or maybe the property they're looking at is
right.
Downtown Panama City, and we can't do it there, but not to fear, we have Regions 100% affordable financing with no PMI. So,
fun fact, did you know that they used to allow USDA on the beach side?
I did know that a long time ago, though.
Yeah. I didn't know that.
Well, not a long time. Was it 10 years ago or something?
Well, that's a long time ago. So.
Yeah.
Wasn't recent. So, okay. So let's talk about, do you guys offer builders loans, building loans?
We do.
Okay.
We have a really good construction program. We have two different. So the first one would be our construction to permanent financing. It's a one-time close. Mm-hmm. What that means is that you can build a house. We will finance the build. So you go hire your builder. You have paid him. You have your plans, your specifications, your survey done. At that point in time, and usually this is a custom home builder.
Right.
So you come to us. We'll finance the project. You pay interest only. It's a one-time close, so that means that we underwrite right up front. Your realtor gets their commission right up front, and then when it's time to modify, usually within 45 days of the home being complete, we just turn it into a fixed-rate mortgage at 30 years, and we lock in your rate up front.
Okay, that's good.
Yes, so if you come to me right now and I lock you in at 3.5%, you pay 3.5% during the construction term.
Okay.
And then whenever your loan adjusts to a fixed rate mortgage, you're at 3.5%.
Okay.
It's not based upon the market.
So with a construction loan, explain how they're paid throughout the process.
Okay. On a draw schedule.
Mm-hmm.
So each institution is different. One thing that I like about our construction program that compared to others that I'm aware of is that we don't have a set schedule on when things have to be completed. We just have a schedule that we expect to kind of go by. So what that means is at first, your builder will go out there, and the first thing they're going to do is get ready and pour that foundation. That's the first thing they're going to do. Mm-hmm. And at that point, you'll have to order a foundation survey to make sure everything is, where it needs to be according to plan. And then you'll order a draw. And what that does is you get an inspector to go out there, or the bank does rather. You tell us, we send an inspector out there. And we say, okay, well, the foundation is poured. X, Y, and Z have been done. So we determine that we can release up to $35,000.
Okay.
And at that point, if your builder needs $35,000, we give it to you, you give it to him, and he pays the subs. Or, say he doesn't, say he's only done $25,000 worth of work, then all you have to get is the $25,000. It goes directly to the borrower, so that means it goes to you, and you pay the subs or the general contractor, whoever. But it's you get up to 7 draws. Okay. So throughout the construction process, and then you get a 12-month term to build your house. I mean, it may take 6 months. We'll give you 6 months, but 12-month maximum.
Okay. Hey, Marat. Okay, so along the same lines, let's say, do you guys do the FHA 203K?
We do not.
Okay.
However, there are some really good lenders that do them here in Panama City.
And for those of you that don't know, the FHA 203K is the rehab loan. And like I explained it to everybody else, if you watch Chip and Joanna Gaines, that's what they use. So you go buy a $50,000 home, you get a mortgage for $200,000, that leaves you with $150,000 to do your renovations. So that's another great program for somebody that wants to rehab and take on a project. So if you're interested in that, contact me and I can get you in touch with somebody that can offer you that.
We do have a renovation loan with agents.
Okay.
It's on FHA, so what that means is you don't get the low down payment.
Okay.
So we do require 10% down, and the credit score minimum is a 720.
Okay.
So it's not as forgiving as an FHA, but the rate is very comparable. So it's kind of like our alternative. Excuse me, I got tongue tied. But we do offer that, and it's for well qualified buyers. So we've had people that's come to us after the storm that, you know, they've owned their home and they have a lot of equity in it, and we can use that equity in their home to meet the down payment requirement.
Okay.
So that's back to construction, switching gears.
Right.
Same thing. So if you own a piece of land and you've owned it for a couple years, and you know, say you bought it for 10 grand and now it's worth 30 grand, well, we'll use whatever your land is worth at that time minus what you owe on it, and that can be your equity injection. So you don't have to come to the table with any cash except for your closing costs.
Okay, that's great. All right. Let's see. What are we missing? Anything?
We talked about doctor mortgage.
There you go. Okay.
So anybody who is a doctor, a dentist, a veterinarian out there, pretty much anybody with a medical degree. So we have a loan program that will allow for 100% financing up to $750,000. It excludes any student loan debt for medical school.
That's great.
Yes. So, and this is, you know, it's for new doctors. It's for doctors that's been there, but the rates are very good. There's no PMI, so no mortgage insurance.
Nice.
So it is a phenomenal program for those of you who are in the medical field, or maybe you are in school to be a physician.
Okay.
It's a really good program.
That's great.
Yeah.
Okay, Marat says, what if I buy a home from someone who had damage from the storm? If they give me an AOB, would I be eligible for these programs?
Oh, AOB. AOB is assignment of benefits.
Yes.
No. We cannot qualify, because what an AOB is basically that you're designating somebody to facilitate the repairs. Typically an AOB would be done with a contractor. Okay. So a contractor cannot go take out a loan on somebody else's home. Especially because, well, let's rewind. The question says, if I buy a home from someone who had damage from the storm, if they gave me an AOB, well, if you buy the home, then it's yours to do with what you please. Now, if you're going in as a contractor to fix somebody else's home...
Well, I can tell you what he's going for here.
Explain to me.
So, he buys a damaged home. Mm-hmm. All right. So, their insurance has said, okay, well, I'll give you this amount, blah, blah, blah. They don't want to deal with it. So, he buys the home, and they sign over their benefits, AOB, for him. And now he has some insurance benefits for it. But he also needs to do other...
I see.
Does that make sense?
So they're signing over their benefits to him. I see. Am
I correct, Marat? Tell me if I am.
I believe that you are, from what you're saying. So the assignment of benefits to do like a renovation program.
AOBs work on the sale of the home.
That is a slippery slope, because the way that the bank determines the value of the home has to do with how long you've owned it. Mm-hmm. And so, say if you buy it and you have the insurance benefits, the bank, at that point, the bank has sold it. So we no longer have to endorse it. We don't have to worry about that. Now, for your purposes, getting a loan, it would be difficult because there's a seasoning requirement, basically.
So I tell you what, I know Marat, and I'm gonna give him your number, and you guys can hook up and discuss it. Does that sound good, Marat? And that way we can and get a solid answer, and we can post it in the comments as well. So.
Yeah, and I would like to do a little more research on that, because I haven't run into that personally, but I don't want to tell you wrong information either.
Exactly, and that's what I always say. If I don't know, I'll tell you I don't know, and I'll go find out for you. So, you know, it's still, even a year after Hurricane Michael, we're all still learning things. It's it was a big learning curve for everyone. So, insurance-wise, mortgage-wise, real estate, everything. So, it's just, we're all still learning from it. Unfortunately.
Yes.
I mean, well, I don't know. Fortunately, really. So hopefully nothing like that will ever happen again. But you know.
And you know what comes to mind? I'm sorry, just thinking about the assignment of benefits. Typically, because when somebody's selling a home, and like say we're in a situation where they're selling it below what they owe for it,
right?
The insurance money would typically just be written off to pay for the remainder of the loan, and then you're looking at you would get whatever excess back. So, say the homeowner wants to sell the home, and they have an insurance check of $70,000, but the home they're selling is for $140,000. They can sell the home for the other $70,000 to make up whatever. I don't know if I'm saying this correctly. You can the
like
homeowner
supplement.
Correct.
Okay.
The homeowner, what the best practice would be is to sell the home and then use the proceeds to pay off the rest, because at that point your mortgage company is going to give you your money back. So say you understand what I'm saying?
I do, but I also I believe I know what he's talking about, but
like to rehab the.
Well, let's say sorry, our phone's ringing here. Someone owns their house outright, and their insurance company is saying we'll give you this, but they don't want to deal with it, you know. So they're just willing to turn over the proceeds and everything to the new buyer.
Right.
Does that make sense? Well, but then he would eventually need more work done to the property to not just bring it back to its original state. Let's say he wants to make it better, you know, and you know, but that'll be something I think you guys can talk about. And
I think that's a very specific situation.
It is,
yeah, because there's so many
different ways it could go.
Yeah.
So if that makes sense.
Yeah, there's so many different ways, and especially right now with what we're seeing, you know, that there are people that are selling homes that are, you know, completely gutted, or you have people selling homes and they just may have, you know, they need a couple shingles on the roof.
Right.
So you just, and it depends on how the mortgage company looks at it. So Marat says, say the damage is worth $200,000 and the insurance paid out $85,000. I would take the remaining benefits, but it may not be enough to repair. Okay. Looking to find financing options. I see. Okay. So at that point, you'd be looking at a renovation loan.
Yeah.
Okay. And, you know, I'm not exactly sure how assignment of benefits works. I'm not an insurance specialist, and maybe we should get one of those in here next time.
And that's okay. I mean, because it's good to, we're both learning here. So, you know, we'll get with our people, and then we'll get with your people. How about that? So, you know,
coordinate.
Yeah. So, but we'll definitely get with you, and I'll give her your information and vice versa, and you guys can discuss. So, and then let me think. We talked about the doctors.
Talked about the doctors. I don't think what else we have to touch on.
I have a question. Okay. So, say someone wants to build, right? Mm-hmm. But they have to find their land first, correct? All right. So, say their lot is going to be $20,000, and they need to come and get financing. What type of financing do you do for that?
We don't do a standalone lot loan. There are places that do. Usually, your smaller banks will.
Yes, I am.
He says, "April, you are my people."
Yeah. You have other people too. Come on.
She's good people. But back to what you were asking, so we don't do a standalone lot loan. Okay. That's something, we see those, and it's usually from like a co-op or like a credit union or a smaller institution that these people have gotten a loan from, and now they want to build. And that same institution does not do the construction loan. So vice versa. We don't do a standalone lot loan, but we do the construction portion of it. Now, if you want to buy your lot and with the intention of you already know that you're building, we can finance the purchase of that lot at the same time as the construction.
Okay.
But that would be back to your realtor.
Yes.
So, you know, you would want to find a lot that already has some features, of course, right. And maybe a lot that's cleared would be a bonus.
Oh yeah, that's always a bonus.
Because then, you know, if it's not, then the borrower ends up having to pay for that. But yeah, we can do the lot loan.
So let's say we find a lot for $10,000. Can they come in and get a personal loan?
You can do a signature loan.
Okay.
Typically they'll loan up to 25% of your income. So,
okay.
You know, if your income is $40,000, then you've got $10,000 to work with there. I'm not on that side of things. I'm on the mortgage side, obviously, but. there are options available. So you can do a secured loan with collateral.
Yeah. Okay.
So, and that's also another thing that, so say that we're talking to some of you who, you're already homeowners and you're looking at, maybe you want an investment property and you want to take advantage of, some of the stuff that's out there right now. So, you can take a line of credit on your home, or even do a cash out refinance and get that cash out, and you can go purchase that property and rehab it yourself. Or you can go, I had a guy that he wanted to buy a condo, and condo requirements are a little bit different.
They are.
And we'll talk about that too.
Okay, good.
Condo requirements are different in Florida, as you know, but typically they like to see 25 to 30% down on an investment property that's going to be a condo.
Okay.
So this guy, he ended up having a line of credit on his house with another bank, and he went out and we arranged it to where he could go get a line of credit and pull it out as his down payment for his condo.
Okay, nice.
And it works out.
Good. All right, so back to condos. Warrantable and non-warrantable. Talk a little bit about that.
A warrantable condo means that it has fallen within Fannie Mae's guidelines that they will secure the purchase of that. So it's eligible for delivery to Fannie Mae. These characteristics are your condos that are owner-occupied, that one person doesn't own more than 10% of the units. The HOA must be in good standing. All units must be in good standing. And they have to have adequate insurance. So these are your condos, if you're familiar with Panama City, like the Landmark condominiums in St. Andrews. Mm-hmm. Those are warrantable condos. When you're thinking of warrantable, you're thinking primary residence type situation.
Not Airbnb or,
Correct.
Okay.
No VRBO.
Yeah.
And what that means for you as a buyer, as in a warrantable condo, your rate is much better because it's on a conventional loan product. It's guaranteed by Fannie Mae, and then you also have a lower down payment requirement.
Okay.
So a lot of times you can get in with 10% down on a primary residence warrantable condo. Not to say that non-warrantable are bad, they just typically, if Fannie Mae doesn't want to pick it up, then that means a bank has to hold it on its books, which a lot of banks don't do. Right. Luckily, Regions does. We do many condo portfolio loans. They are for what we call in Panama City Beach condo-tels, meaning that it is a condo that is owned and operated like a hotel motel at a nightly or a weekly rate. The best way to tell is, and this is for my realtors out there, mm-hmm. If you're showing a condo, or if you see one that's listed, go type in on Google that the name of the project, and if the first thing that pops up is VRBO or Booking.com, then it is
red flag.
100% condo-tel.
Well, I say red flag, not red flag that it's bad, but that way you'll know,
And there's a bigger down payment requirement.
There is, yes.
The rate is a little bit more enhanced to account for that. Not to say that it's bad, but you've got to think about it like this: if you're buying an investment condo, and your rate is 5.5% compared to the rates right now are going for 3.5%, 4% on regular conventional loans. That 5.5% isn't really so bad if you think about the return you're going to get on your investment.
Yes. Yeah.
Especially at a nightly and a weekly rental rate opposed to long-term rental rate, you're going to make more money hand over fist than you would in a typical situation. So, my best advice is when you're looking at a condo, get with your realtor, and she will be able to guide you as to what projects you can and cannot, or maybe it's not a situation that you can or cannot. Maybe you have 50% down, and maybe you have an 800 credit score, so the possibilities are endless. But maybe
you don't want to.
Maybe you don't want to. Maybe
your prerogative.
That's exactly right. Well, and maybe it's your primary residence. Maybe you're retiring. Maybe you're VA. There are VA approved condos.
Yeah, there are a few. Not many, but there's.
I think there's one. Maybe.
Yeah, I think just one.
Just one.
Yeah.
But still, so it may not be, don't let that scare you off. Just know that it's out there, and if it's something that you think that maybe you couldn't get anywhere else, we can typically do it.
Right. Okay. All right. So
No mobile homes. We don't do mobile homes.
That's another thing I was going to ask. Now, okay, so mobile homes, what about manufactured?
That's a slippery slope again. Mm-hmm. Manufactured, if it's already there, and if it's zoned correctly.
Okay. So a manufactured home, let me tell you the difference. A mobile home is a mobile home. Like, you can hook it up and tow it. So a manufactured home is where they bring in, it's like a puzzle. They put it together like a puzzle. So they'll bring in the walls already put together, the roof lines already put together, and they just, it's like Lincoln Logs. They put it together.
They snap it together.
Yeah. So that's the difference. Now, there are lenders here that will loan on mobile homes, and there's guidelines on those as well. And if you're interested, contact me, and I can get you in touch with one of those lenders. And we all know that Panama City, or Florida in general, we have a lot of mobile homes. So that's fine. It's just depending on the lender. So
you want to call your real estate agent first. So
yes.
It's easier for you to call your realtor first and find out who you can call rather than having to make all those calls yourself.
Yes.
If she knows where to go, then go to her. She can be your one-stop shop.
One stop. Right here.
Walmart.
Target, baby.
Okay, Target.
Target. Okay, so if you are thinking of a manufactured home, you know, I can send her the information, see if she'll cover it or not. Let's just see where it's at.
Well, typically what it is manufactured homes too. A lot of people, you want one from the ground up. And usually those places will finance you during the construction part of it. And then you just get somebody to pick it up. And that's where we come in. But we actually don't finance the actual build of the manufacturer.
So what about a resale?
Yes, a resale.
Okay.
That's perfectly fine.
Okay.
And that's even to say, we'll switch gears and go back to construction really quickly. So if you're buying a house from one of these big builders like Samuel Taylor, D.R. Horton, or somebody who they're spec homes, they're not custom homes, so they're already built. You can go look at your floor plan, and usually that person or that place is going to finance your build for you. So D.R. Horton is going to build the house, and just knowing that you will be eligible to buy it once it's built. Mm-hmm. So what we can do is we can lock in your rate right now at the market where it's at, and we can hold that for you as long as you're pre-qualified. We'll go ahead and get you pre-approved, and we'll hold that rate for you until the home is complete.
Okay.
And then we'll do a regular fixed rate mortgage.
Good. Okay. So Sheila says, thanks for your time to answer all these questions for us.
You're welcome. I'm glad that you guys joined us. I hope everybody's gotten some good information.
And they'll, if they're anything like me, they'll think of 10 more once we're done with this. And you can call me, text me, email me, or Lindsay. I'll have her information there again. But I wanted to ask you, on new builds or even resales, I guess, does Region ever do anything towards closing costs or down payment? Like,
we don't have a program.
Okay.
So, again, we have the agency first time home buyer that if you're buying, a home that's already built, mm-hmm. we will pay the closing costs for you. But you'll see places that they're offering, they'll say, oh, well, we're going to pay $2,000 of your closing costs. We don't have a hard, fast number that we pay. We just, if your home that you're buying from Samuel Taylor is, $250,000, we're going to pay every single closing cost.
Okay.
So,
Bunko people, they're screaming again.
Somebody won.
Somebody won. Wasn't me, but somebody won. Okay, so also, they made me forget what I was gonna say.
Oh no! Darn it, Bunko.
Oh no! Dang it! Somebody won.
Does anybody have any questions for us that's watching?
What's for dinner? Anybody cooking? I'm just wondering. So, let's see. It's about. That's what happens when you get old. You forget.
Well, that's okay. Just hang in there with us.
I remember.
Yay!
Light bulb. Ding. Okay. So, closing costs. I hear some lenders talk about rolling those into the loan.
Mm-hmm.
Talk to me about it.
Some lenders do that. We will do it on a refinance.
Okay.
We'll do it on a refinance. Okay. So, you know, that's one of those things that you also want to be aware to compare what you're paying. So, what I like to do for people, you know, they have the option. Do they want to put it into the loan or do they want to pay it up front? Depending, again, on how long you've got left on the loan, or if you're refinancing into 30 years, I don't always recommend rolling the closing costs into it because then you're paying. Yay! I'll be looking for your call, Christina.
Hopefully it'll be real soon, right, Christina?
Hopefully. But you just want somebody that's going to look out for your best interest when it comes to that. Now, if it's a point where you just don't have the money and you don't, you know, or you don't want to take it, say you have it bearing interest somewhere else that's, you know, paying more. But typically you don't want to do that if it's a long-term loan. Now, if you're refinancing, you've paid on it 15 years and you've got 15 left, then go for it. I mean, especially because if your balance is low. But if you're refinancing a larger loan amount, you don't always want to do that. USDA, you can do that on a purchase. We don't really have any other programs that let you. Now, that's not to say that you can't get a down payment assistance program.
Okay.
Because that is going to pay for your closing cost and your down payment. But each program, so for instance, conventional FHA, they have their own allowances on how much they'll let you go over the loan to value.
We're still here. Okay. Can everybody still hear us? My daughter just came in to tell me that theirs cut off, so.
Oh no.
Christina, you still there? Anybody there?
Hello? Can y'all see us? Hello? Hello? SMS?
Hello? Okay, it's loud. Okay. Bunko people are loud. So, okay, so it still shows we're going, so I think we're okay. I think it was probably hers. Operator error, maybe. Okay. So, okay. So, closing costs we're talking about that. So somebody wants to pull from their 401k for closing costs.
That's a great question. Yes. Okay. Yes, they can. Typically, what we'll want to see from somebody that's pulling from their 401k is we'll want to see how much is vested. So you'll want to bring a quarterly statement. That will show how much you're vested and what kind of account it is.
Okay.
Whether it's 401k, 403b, TSP, they all have
ABC.
their ABC, DEFG, XYZ, you and me. They each have their own kind of rules how they let people withdraw on that.
Okay.
So
don't go take the money out and then ask.
That's right. Don't go take the money out.
This is not one of those, ask for forgiveness later. It's really call first.
Yes, and that goes down to, okay, so anything that you do if you are looking to buy a house within the next 90 days, leave your finances alone.
Do not go buy furniture.
Don't go buy furniture. Don't go buy appliances.
A car.
Don't
nothing,
go buy a car.
Nothing.
Don't pay off your car. And why I say that.
Oh.
Uh-oh.
No, don't leave me. Are we still here?
We're still here.
Hello?
Well, if we're still here.
I hope I'm still here.
Don't change your financial situation because the bank will want to see where that money came from and where it went.
Yes.
So I had a borrower and I told him, in order to decrease his debt, we're going to need to pay off his car. And he says, okay, well then he goes and pays it off. I didn't clarify to him that we're going to pay it off at closing. So it's fine. It still happened, but it's a lot more intense on the borrower.
It is. Okay. But I need a car. Okay. Christina, call her and you can, I'll kind of tell her your situation too because I know it. So
we'll work it out.
Yeah. So, okay. So I think we touched on just about everything. We can probably keep going on a lot of things, but
do you want to talk to them about anything that
Yes. So right now, if you are in need of a home, call me. I'll find you one. No, but really, there is a housing shortage basically because so many people are needing a home, and you know, the military side, we lost our base housing, and we don't have the rentals there on base, and TLF, we lost those as well. They are working on bringing back the TLF. I haven't gotten a time frame on that lately.
I want to say December is when they're going to start opening a portion of them back up, because a private investor came in and rehabbed those.
Yes. So TLF will be great because, you know, when you come and you need to house hunt, or there's always that transition period for military, which if you're military, you know what I'm talking about. You know, you come and you still have a week for closing, or a few days. You need somewhere to stay for the time being. And but, you know, if you find a home, if you're working with me, and if you're not, you should be. But if you're working with me and you found a home and you really love it, my advice to you is don't wait, because it won't be there the next day more than likely. It just, they go so fast. And I really hate being the person to, you know, if you like it, you need to make an offer, make an offer, make an offer. I don't want to sound like a used car salesman, but it's just the facts. It really is. They go quick. And if you are uncertain of what you need, sometimes your wants get in the way of what you need, and vice versa. If you call and discuss what you like to see for your family, give me your family size, the income, I can help you, because a lot of people don't even realize functionality, you know, is in square footage. You know, square footage of a single-story home and a two-story home can be, your single-story home can be a smaller square footage than the two-story, but the single-story is going to feel bigger. So, because you don't have stairs that take up room in the home. There's just so many things that, you know, I can help you realize. And I can refer you to Lindsey. I have home inspectors that are awesome, survey companies. So call me and we can get going. So I'll put my information in the details. Either somebody won again at Bunko or they're dying.
Yeah, something's happening back there.
I'm going to put the information in the details, and thank you everybody that watched. And
thank you.
You know, I've done Facebook Lives in the past, and it's been a while since I've done any because life, it happens. And but I will be putting this on my YouTube channel, and also it'll be on my Facebook page. Lindsey can share it as well if she wants. And but I'll try to do some more Facebook Lives. Maybe we can do another one and touch base.
Maybe we'll do a monthly one. If we have enough people that request it, we could do a monthly one.
That'd be good. Maybe
do some giveaways.
Hey, I like free stuff.
Will this be available to watch a replay? Yes,
of course. Definitely, Christina. I always save them, and like I said, I'll put it on my YouTube channel, and you can share it either way, Facebook or YouTube. It won't be tonight, though, because I'm tired and I'm hungry, so... So hopefully next time we can do it sooner than later. So thank you for joining us.
Let us know if this was helpful to you guys. Write a comment, or you know, if there's something that you'd like to see more of, tell us. Or you know, if there's something that you didn't like, you know, let us know how we can serve you, because that's what we're here for. Right. And also, please share it. So, you know, there's always somebody out there that can probably benefit from what we discussed. So even if you can't, which I don't see how you couldn't have, because we're awesome. I'm just kidding. But so share it. You know, maybe your friends can benefit. I still run into people that didn't even know the disaster program was out there, and they would qualify for it. So. But anyway, I'll put my information in there, her information, and I hope everyone has a great night, and we will see you soon. Bye, everybody. Bye.